Taxes are likely to be one of your largest retirement expenses, and they may be on the increase in future years. But if you can take steps now, you can reduce them so that it's not as bad in your retirement years. In this video, I'm going to give you 3 things that you can do now so that you can pay less tax over your lifetime and in retirement. But first, welcome back, or if I haven't met you yet, I'm Dave Zoller and I run Streamline Financial, a wealth management firm, and I run that company with my business partner, Tim, and our team. And we help people plan for and live their ideal retirement. So if you're currently paying an advisor that's only helping with investments or investment management, and they don't help with retirement income planning or tax planning or withdrawal strategies, please reach out to me because I may be able to help make sure that you're doing everything you should be. You might be surprised that the majority of people who do call me, they have a tax problem, not an investment problem. The crux of the problem is that many people have been taught to delay taxes by putting money into their 401k or 403b and just let it grow. The concern is that triggering the required minimum distribution, or RMD, at age 72 might result in a tax time bomb, especially if future rates are going to be higher than they are now. The IRS sets these withdrawal limits, which may require you to withdraw more money than you need in 1 year, which results in a higher tax bill. If you feel like many people do that taxes may rise in the future, there are some things to think about to reduce your tax liability in retirement. And please remember, since I don't know your specific situation and your entire financial life, please don't take this as specific advice. There's a lot of opinions out there, and these are my opinions. And I hope that they just give you some ideas before you talk to a financial professional. So the first thing to think about is withdrawing money while rates are low. Because today's tax rates are so low, it could be a smart idea to retire early and possibly start taking money from some of those tax deferred accounts. Maybe spend down some of the IRAs or 401ks now to take advantage of lower tax rates, but only if you have already reached the age of 59 and a half, when you won't be penalized by the IRS for early withdrawals. If you don't know if this is going to be a good idea, then think about calculating your required minimum distribution at age 72 and then what you expect your expenses to be. If the RMD is way higher than your expenses, then it might be a good idea to start withdrawing money from your IRA or 401k earlier than planned. The goal is to prevent significant withdrawals of tax-deferred money at future higher tax rates. Now you might be thinking, well, I don't want to withdraw money from my IRA because I like my work and I'm going to continue to work and I don't need the money. So the second idea could be an option, and that is possibly converting to a Roth IRA. Roth IRAs, unlike traditional IRAs, are funded using after-tax funds, and contributions are not tax deductible. The main distinction is that once you've begun withdrawing money, it's not taxable income as long as it's a qualified distribution. Now, if you do a Roth conversion, you will incur taxes on the whole amount that's transferred from a traditional IRA to a Roth IRA, but the advantage comes in the long term. A Roth IRA could make sense if you think that your taxes are going to be higher in your retirement than they are now. There are no restrictions on the number of conversions or the financial sums that can be converted. That's currently in 2021. One possible goal, though, could be to convert as much as possible without entering into the next higher tax band. Aside from Roth conversions, you might be able to contribute to your Roth IRA if you're still working. The maximum contribution in 2021 is $6,000 or $7,000 if you're over 50, but be warned, contributions are subject to income limits. A Roth IRA isn't available for singles who are making more than $140K per year, or married couples who are making more than or earning more than $208,000 per year. Now, the third way to pay less tax in retirement is to simply just know what you will pay tax on ahead of time before you get there. That way you won't get caught off guard and you can easily plan out when you'd like to pay this certain amounts of tax. There are 3 major sources of taxed retirement income to discuss with your financial advisor, and understanding the difference between these can aid in the development of the income planning strategies to reduce taxes in retirement. Number 1 is just your investments in non-retirement accounts. So short-term capital gains are taxed at regular income rates if you've held those investments for less than a year. Long-term capital gains, on the other hand, are taxed at either the 0, the 15%, or the 20% tax bracket, depending on your income level. Of course, this could change with some of the tax proposals happening right now with the Biden administration, but that's where they are currently. A lot of the clients who actually start working with us, they're invested, or their investments are in pretty tax inefficient funds, and they're paying more than they should each year on capital gains and interest and dividends. So that's something important to look at. The second retirement income is Social Security. To see if your Social Security benefit is taxable, add up your adjusted gross income, your non-taxable interest, and half of your benefit for your total income. Currently in 2021, if your combined individual income is more than $34K as an individual or $44K as a married couple, then up to 85% of your Social Security benefit may be taxed. A third common taxable income that we see is payment of annuities. There are certain tax advantages that are available with annuities. They can be bought within pre-tax accounts, but then the payments are usually coming out as taxable income. However, annuities can also be bought in after-tax accounts, in which case only the earnings are taxed. When it comes to annuities, there's a lot of different options out there, and a specialist can help you choose one that fits you, or really just evaluate ones that you currently have, and just make sure that you can budget right and how much you're going to be paying in tax on those distributions. The final thing to discuss is whether or not taxes or tax rates are going to be going up in the future for you. But before we do, please like and subscribe this video if you found it helpful so far. That way, then you can see the next retirement focused video that I'm going to do next week. A lot of people look at historical cyclical patterns of tax rates, and then they kind of see that we're on the lower end of the cycle. And some people think that this increase in government spending, they think it's got to be paid somehow, and taxes are really just one of two ways that the government can pay off their debt. But whatever you think, it makes sense either way to map out your retirement picture in a way where you can see expected income and withdrawals, and then plug in different tax scenarios, either tax scenarios staying the same, going down, or going up. And this can be confusing, and it's something that real wealth managers do. They take all of your financials and your investments, your taxes, the withdrawal plan, the estate plan, and then they fit it together to come up with your ideal picture. If you're not currently getting that with your investment advisor or investment person, then reach out to me. I'd be glad to have a conversation. And again, I hope this was helpful. Be sure to subscribe, and then I'll see you in the next video. Take care.